Hey there, traders and investors. Todd Gordon here, co-founder of New Age Wealth Advisors. My partner and I, Ryan Boucher, we just launched the wealth management business. We've been up and running in a soft launch. Brought Ryan on, who's a friend of mine. He's a super sharp guy with a lot of experience in the business. Holds the CFP and CPA designation, so he's taking care of the planning. I'm taking care of the investment side, portfolio management, and it takes that to run a comprehensive and a full, let's call it a boutique. We are boutique, but a full offering for a wealth management business, and specifically a digital wealth management business. Ryan wrote a really good article. I'll try to link that below, so check that out. But lots going on here today. Groundhog's Day, a whole new setup, tech setup here. I'll try not to fumble around with this too much, but it's Groundhog's Day. It's my birthday. It takes a real man, let me tell you, to be born either on Groundhog's Day or April Fool's Day. So Groundhog did not see a shadow. No, he saw a shadow. He saw a shadow, so that means 6 more weeks of winter. And the question here is, does that mean 6 more weeks of volatility, or are we in the springtime? So we'll jump into that a little bit, talk about what's going on in the markets from our point of view. And also at the back end of this video, I do want to talk about the hedged equity portfolio that we are going to introduce for clients of New Age. So if you're a little afraid of volatility, hang in here until the end, or you can skip right to the end. Okay, so here we go. Earnings out. I did CNBC today, really fun. I was on for a good 10-15 minutes with Kelly Evans. That was super fun, talking about Qualcomm. We talked about Facebook, both of which were not very positive earnings reports, as well as Spotify, all the controversy there. So earnings for the most part has been really solid. Apple, blowout earnings. Google, blowout earnings. Facebook just really dropped here, and that was not too surprising, as they are going to invest quite a bit in the new virtual reality labs. That's their AR/VR branch. So I don't think they were expecting too much from them. We hold a small position of Facebook in our growth portfolio, like 1%, which is 1.25% target, which is not very large. We are looking up. We're looking at Amazon and Ford coming up tomorrow. Ford's a good holding. It's a top 6 holding in our growth portfolio. So let's certainly watch that one. So big question, guys, is where's the market going? I don't know. Nobody knows, right? All you can do is assess what's happening right now with all the tools that you have available to you and figure out the best place to be positioned. So there are new clients coming in to New Age, and those of you who are new, a lot of you are still sitting on some cash and waiting. We've had discussions, Ryan and I have had discussions with you about when we're going to deploy that cash. So we'll kind of shed some light on that in this video, but we're waiting. I will give you the technicals of the market at the end. I want to talk about some of the internals. I want to talk about interest rates, because those are obviously very, very important. So the first thing that I want to do is this. I want to talk about the yield spread and talk about the upcoming rate hike. So the Fed is going to raise rates. Okay, so at the March meeting here, we have a 94% chance, according to the Fed Fund futures, of going from 0 to 25 basis points up to 25 to 50 at the March meeting. May, from there, there's actually a pretty good chance 50 to 75, another 25 basis points going to 70. 5 is the base, and let's go out to June. Do we go up from 75 to 1? We don't, and then we start to drop off there, and that kind of leads me into the point that I want to make here. Let me do this. Okay. So the idea here with the Fed Fund futures is where the Fed sets interest rates is going to be reflected in the short end of the yield curve. And we've spoken about this in the videos recently. It's really, really important. A lot of the videos have been focused on the fixed income and interest rate markets because really fixed income is what should drive equity markets. Okay, it should be fixed income, should be FX driving equities and then commodities. That's kind of the long-term play. So it's important that yields are moving. So what we're looking at here, guys, is the spread between the 2-year, which is the short term, which is very impacted by the Fed, and the 10-year, which is not the longest duration because we do get up into the 30s, but the 10s minus the 2s is the sort of the common garden variety spread that everyone looks at. As this spread is getting lower, okay, what's happening is the difference, okay, between the longer dated 10 is compressing to usually the shorter dated and the lesser yielding 2, right? The shorter the yields, usually the less their price, and then as you go higher, usually it's in duration, you get higher in price. And this is if I turn around, that is so shorter duration is usually lower, longer duration is usually higher. That's a normal sloping yield curve. If I did it to you like this way, it would be backwards. So what we're doing here is you're seeing back in 2018 and 19, in purple is 10s and in orange is 2s, and you can see the physical distance between these two getting less, and that is being reflected in the 10s minus 2s. So the spread got narrow, and that's a big reason, okay, why we saw volatility here in the S&P, which is in blue. Now, keep in mind, I think we raised once in 2015, once in 2016, and then in 2017, I think the Fed raised 3 times, and then in 2018, Fed raised 4 times, and that's why you're seeing a narrowing of the 10s, 2s, creating the volatility. That's when Trump was all over Powell and giving him a really hard time about tightening monetary policy. The deal here is, okay, look at the big spread over here post-COVID as the Fed slashed interest rates. 10s stayed up, 2s, shorter end got smushed. Over here, you can see that the stock market in blue is rallying quite sharply. What's happening now, though, as we're moving into another Fed rate tightening cycle, is the spread is getting lower again. So will we go into something like this that we saw pre-COVID? The Fed just had a wonderful example of what the stock market does, which was a lot of sideways volatility in 2018-19 and a tightening rate cycle. But guys, we're still in a pandemic. The Fed clearly remembers this. Jerome Powell took a ton of heat from Trump for raising rates. Of course, Biden is going to approach it much differently than Trump is, and being only 1 year into his administration. But I don't think the Fed is going to allow the spread to get this tight to create this kind of price action in the cases we are still in a pandemic. True, we do have inflation, but there are signs that inflation is starting to moderate. So I don't think we're going to see a tightening of the yield curve down here where we got almost to zero. We're 10s and 2s at the same price. Okay, we're still at 60 bips different. So don't think that's really going to be the case there, okay? Looking at a couple other things here, let's take a look at how bearish the market got. Let me use my fancy swisher. In March of 2020, okay, I mean, like, it wasn't a 2008 like a loss of the financial system, but it was pretty bad. It was a global pandemic. Markets are getting absolutely destroyed. And what we're going to do is measure the AAII investor sentiment, which measures the amount of bulls versus bears. And there's a lot of kind of things that go into sources that go into computing this stat. It's like newsletter writers, it's analysts, it's a pretty widely accepted survey here. So what we're going to look at now is the top is the percent of bullish, I'll call it investors, just to lump everything in there. Percent of bullish investors, percent of bearish investors, and then the net. Okay, so 2020, you can see that the amount of bearish investors right here got very, very high, 50, 48 something percent, and the amount of Bullish investors got very low. The net difference was down here around 29, about minus 29% right here, okay? So you can see there's been a couple cases in 2019. Again, we just talked about volatility there. There's late 19, there's 2020. But what's interesting is the amount of bearish investors out there, 52%, enough to push the spread down to minus, call it 30%, which was the lowest on record. So what this is just a recent reading. There was more bearish sentiment in the last month than there was at the depths of the pandemic, just because the Fed is going on an increasing interest rate cycle, because we do have inflation, which we've spoken about that in different videos, which I think is partially man-made, partially we're just getting caught up. A lot of different industries and sectors have to retool to catch up with very strong demand and a economy that I think is really strong coming out of a pandemic, which could have sunk the economy, but it didn't. So the markets got way too bearish, okay? Way too bearish. Markets got too bearish during the last month, and we saw a very, very sharp sell-off. Okay, let's take a look at this. Another chart I want to bring your attention to. So this is vol skew, and this is a little bit more kind of crazy from my old trading days, but vol skew is basically the difference in pricing of out of the money puts and calls in the S&P. Long story short, okay, used to be if a call option 10% above the market and a put option 10% below the market were priced similarly, okay? Then all of a sudden 1987 crash came along and they realized, oops, puts need to be a lot more expensive. 10% down puts need to be a lot more expensive than 10% upside calls, because markets don't crash up, they crash down. There's always a higher demand for puts, so there's always going to be a higher value to downside puts, which is the skew, okay? And what happens here is generally as the market's going higher, people get comfortable. People get complacent. They don't feel the need to pay for as much for downside protection, so those puts don't have as much demand, so that skew goes up. What's happened recently is the opposite. As the market has continued higher in 21 and now here we are in 22, look what happened to the skew. These downside puts are getting a lot more expensive. Granted, it is partially to do with the VIX, with volatility at the money puts and calls, has to do with interest rates going up, has to do with inflation, but people are really paying for out of the money insurance and the market continues to go higher, okay? So that does create some sort of short interest, that sort of a short dynamic that people are wrong and they're going to need to get back into the market. If this skew continues lower, people are really buying downside put protection. I take that as a counter trend indicator. Okay, so that tells me that I think the market got too bearish, just like that AAII sentiment, as I just showed you, between bulls and bears. Okay, let's talk about longer term. I think a lot of people are saying, how could these, I'm just going to bring up this other one here. How can these crazy valuations continue? How can this market continue to absolutely rip higher? And I want to show you the reason that the markets continue to move higher. The reason I don't think we're in a bubble is I think market capitalization of the S&P compared to, let's call it 2006, pre-housing crisis, 1998 to 2000 tech bubble. The market capitalization is much higher. Okay, obviously as stock prices get higher, the Fed has put a lot of liquidity into the system. But what happens here is the reason I don't think we're in a bubble is because these companies are making a lot of money. The reason they're making a lot of money is they're running more efficiently. They're replacing a lot of labor, unfortunately, that's not needed, that can be replaced with technology. They're outsourcing labor. They're outsourcing the creation of this technology overseas. So we have the globalization of the workforce. Companies are just making a lot more money. They're also much more responsible to the shareholders, as stock trading has become such a big part of our lives. And now you can see with the meme stock, 20 and 30-year-olds and 40-year-olds are really getting involved as well. So they're very accountable to the shareholders, and they're cutting off segments of their business that are inefficient. So companies are running meat much tighter. And what that means, guys, is margins are going higher. Okay? Margins are going a lot higher. This is from Ed Yardini. This is the profit margin on the S&P 500 going all the way back to the 90s, late or mid 90s. Okay, so in blue is the operating margin, in red is the reported margin, and you can see that the margins for the S&P 500 is up around 13%, which at the 2000 mark around 7 to 8%. So companies are running almost twice as lean as they were. Profits are increasing, but expenses are going down, as I said, because they're running more efficiently. And a lot of it has to do with technology. Okay, so again, just looking at several different iterations of the profit margin, and you can see we're running at about 13.5% profit margin on the S&P. So companies are just making so much more money. And if you look at this, this is from FactSet. This is broken down by sectors, okay, in terms of operating efficiency. Here's the S&P right in the middle here at about 12 to 13%, and we're comparing last year, calendar year 21, sorry, this year to, no, it is 21. So 21 versus forward estimates of profit margin for 22, and you can see that we are looking to get more efficient. So calendar year 22, they're looking for like 12.8%, where this year we're looking at 12.6, only 0.2%, but still an improvement. Okay, these are the sectors that are running most efficiently. So we have tech, no surprise there. I just did Facebook on CBC. Their gross profit margins like 80%. Their operating margins like 54%. Just doesn't take a lot of money to run technology companies. The hardware companies like Apple have much lower margins because of obviously input costs. Real estate's the highest margin business there is because you're not creating anything. Financials, utilities. So some of the biggest differences between the two, okay, between what we did last year and what they're expected to do this year, margins are expected to increase a lot in industrials. Look at the difference here, 10.3 versus 8.4. Energy 9.3 versus 7.6, and consumer discretionary. Those are the sectors that are leading right now. Okay, it's interesting. Technology is supposed to be flat, but again, there's a lot of different kinds of technology. Okay, you've got hardware companies, you've got software companies, you've got semiconductors that are obviously very resource and input intensive. So a lot of different guys there. Margins are actually supposed to decrease in financials. Interesting, 17.6 versus 19.8. Got to think because cost of money is going up. I think that's why they're starting to price in less margins in financials. But we're seeing pretty good leadership here. And some of these names are well-positioned in energy. We are well-positioned in industrials as well as financials. Okay, so we'll see how increasing interest rates do serve financials. Okay, so from there, let's go over to the market. This is to investors. Again, we're still, if you're new, we are still sitting on cash, moving slowly into the market. I'm watching how our earnings are going, which thus far season has been really strong. But I am also watching the technicals. Okay, I'm happy with where we're positioned. We are going to rebalance here soon. So you'll see some changes to the portfolio coming up in the next week or so. And again, if you're new and you're sitting on some cash, we are waiting for a little bit more companies to report, as well as some clarity on the technicals. So, real simple, guys. This is the S&P weekly. I'm worried about this right here. Okay, so it's possible that is 5 waves up from March. Oh, sorry, that was actually October of 20. 1, 2, 3, 4. I don't think so. I don't think this is it. I just want to guard against this a little bit. I want to guard that broken trend line support through that 5-wave channel is not going to offer resistance right around this 4,600 level in the S&P. Okay, so 45.80, 46.25. This is going to be a very telling zone in the S&P. Let's go over to the NASDAQ. I just don't want to put money to work right into the backside of broken resistance. Okay, kind of similar thing here. I like this wave count better, that this is wave 4 and we are going to move up in wave 5. You don't have the same kind of broken trend line support until higher, little higher here in the NASDAQ, but same kind of situation. Just want to guard against this being ABC X. We get stuff to resistance and then we go back down. That's what we're guarding against. Okay, so I'm going to continue to watch what we're doing. Going to continue to watch what we're doing against those resistance, and again see how we're handling earnings. So one thing I did tell you I want to talk about is the new portfolio that we're going to be coming out with, which is the hedged equity. If you've been with us for a while, you've heard about it, and what it is a offering to clients who first are hesitant of the equity market in general for all the reasons we've spoken about. 2, already have enough equity exposure but aren't happy with their fixed income exposure because fixed income really has negative yield right now because where inflation is running, you can't earn that yield to overcome inflation in the fixed income market without taking too much risk. So we've come up with a solution, which I'm leaning on my long history of trading options in the portfolio management world to offer an ability to get more equity exposure, but with guardrails. Okay, and I've spoken to all of our clients about this, and the time has come that we're gonna look to launch this. So if we've spoken to you about it, we'll be in contact. If it's something you'd like to know more about or you'd like to reach out, just email us, and either Ryan and I or both of us will call you. But basically the short and skinny of it is it's going to be a long stock holding position. We'll be doing it most likely in the SPY. Okay, the ETF that tracks the S&P. And what we're going to do is buy downside put protection. We're going to do it quarterly. We are going to structure it approximately buying a down 5% put, selling a down 20% put. That's going to create a put debit spread. It's going to be a debit. Okay, that's going to give you protection. Okay, each quarter, okay, if the S&P goes down intra-quarter from 5% to down 20%, you are protected. You will be down, but you will be down roughly, these numbers are approximate, roughly 5%, okay, as the S&P right here is down 20%, okay? If the market is anywhere from less, let's say, better than down 5%, 4, 3 even, you will participate on the upside. We're also going to sell upside calls that will cap the upside. Okay, by selling the upside calls, it'll be approximately 5 to 7% out of the money depending on where volatility is. By selling those upside calls, it's going to help us finance the downside put spread. So what this is going to do is give you roughly between down 5 and up 5 per quarter. The options are going to come off at the end of every quarter. We're going to reset them every quarter. So you will have upside participation to this degree per quarter. It's a great way, I think, to get additional stock market exposure, but with these guardrails on, and a great way to overcome the negative real yields we have, as well as if you have enough equity exposure that is unhedged, so to speak. This is a great way to do it. We've had a lot of interest in this product, and something we're looking forward to rolling out. So let us know if you're interested. Okay, long enough video. This is obviously only for investors who are comfortable, who know the risks with options. And my kids are going crazy over there. It is my birthday. They're waiting for me to do birthday, so I'm gonna leave it there. But anyways, check us out at newagewealth.com. To our investors, thank you. We're going to be doing these weekly. Ryan and I have been working really hard behind the scenes with a lot of different things. We can't wait to get into a routine and get some momentum going without the chaos of an upstart business. But everything is great. Everything's fine. We've been working really hard. Very proud of what we put out there. And watch this. Here's something cool else I did. Ready? I think this is my little Kramer. Ready? I think this is the kind of market we're in. As long as we get through the resistance, green light buy, we'll be neutral right now. We'll go back to New Age Wealth Blue. All right, guys. Have a great night, and we'll see you on the next video update.